All of my real estate investors, that's right, my landlords, those who have property and they rent it out to a tenant with a lease and they collect rental income, or those who are going to purchase rental property. It's important that we discuss the tax benefits. A lot of times we're engrossed in cash flow, but a lot of times your tax flow is far greater than your cash flow, and it's far more important. So let's talk about the tax side of owning investment property. Now, again, this is not for people who have a primary residence or who rent rooms in their primary residence. This has to be rental property, and this includes multi-family units where you as the owner may live in one unit but rent out the other units, right? Unlike your primary residence where you may rent out rooms. As long as you do not live in the property and you are a real estate investor, you collect rental income, this is for you. So the One Big Beautiful Bill did something that was extremely important and a huge wealth builder for small business owners, large business owners, and real estate investors, small and large alike, not just billionaires and trillionaires and millionaires, okay? So what did it do? It extended the Tax Cuts and Jobs Act permanently in the form of 100% bonus depreciation. The 100% is important. So prior to the One Big Beautiful Bill, bonus depreciation had a schedule: 100%, 80%, 60%, 40%, and it would phase out in 2027 to zero. What the One Big Beautiful Bill did was extend 100% bonus depreciation. What does this mean? So I'll break this down as much as I can so that you understand how important it is. Now, if you have a rental property, you can depreciate it over its useful life. Now, I'm going to talk about your regular residential property. For residential property, it's 27 and a half years you get to depreciate it. For commercial property, which is 5 units or more, or short-term rentals, it's 39 years. So what the tax code says is we're going to take the purchase price of your property minus your land value. That's going to be your depreciable basis. So if you purchase a rental property, a multifamily, say $700,000, and your land value is $50,000, and you can get this from your local jurisdiction, your county tax assessor's office or whatever have you. And then you subtract the land value because land is not expensed, right? You can't depreciate land, and you get your depreciable basis. So in this example, it's 650, right? 700,000 purchase price, 50,000 land value, 650,000 depreciable basis, right? We have to remove land. Now that 650,000 is divided by 27 and a half years, and it comes out to about $26,000 per year. Now you may purchase your property in the middle of the year. It's prorated for when you purchase your property for the start date, right? So if you purchased in June or July, it's going to be half that, right? So for every year you get this, 26,000 or so in your expense, okay? And what the tax code says is, hey, we understand that you have other items associated with this rental, okay, that are depreciable over a short period of time, right? A shorter period of time. Why? Because this asset is now a part of a business. You're going to have tenants. So if you have a lot of tenant turnover, right, over the course of the 27 and a half years, you're going to have wear and tear on items, right? Your carpeting is not going to last 27 and a half years. Your appliances are not going to last 27 and a half years, right? A lot of times, any of these items, they don't last 27 and a half years. Your blinds, all of these things, your ceiling fans, your fixtures, they don't last your fencing doesn't last 27 and a half years. So the IRS says we understand that. So we're going to take your purchase price minus your land value, just like regular depreciation, and we're going to allocate a cost, okay? We're going to allocate a cost of these items, right, in relation to your depreciable basis. So you have your 5-year items and your 15-year items typically, right? They must be depreciable under 20 years. Okay, so your 5-year items are things like your appliances, like your fridge, your stove, right, your microwave, things of that nature, your appliance wiring, your kitchen cabinets, your countertops, your removable flooring, your carpeting, your blinds, your fixtures, your ceiling fixtures, etc. Okay, these are items that can get damaged in the course of renting your property over decades, right? 27 and a half years. And so the government says, I'm going to give you a chance to take the cost in the first year you place the asset in service, right? The first year your property is available and ready for rent, meaning you don't necessarily have to have a tenant in there, but it has to be ready and available, right? Maybe you just couldn't get a tenant. It's a slow market, but it's listed, right? And so in the example, right, I get my regular depreciation, okay, 23 or 26,000. I can't do the quick math, right? Over the 27 and a half years, and then you get an allocated cost. You don't have to spend, you don't have to do any improvements. You don't have to do any renovations. You get this cost just because you purchased the property and placed it in service, right? It's in the first year you place the asset in service. Now, if you have a primary residence and you want to convert it into a rental and it's within the actual time frame of 2025, you can get the 100% bonus depreciation, okay? And there are some caveats like be careful if you've inherited property, if you purchased the property from a related party like mom, dad, grandma, grandpa, siblings, linear descendants. So now you'll get an additional cost for these items. So each item is separated out, right? Like I listed, the carpeting, the flooring, and there's a cost from the $650,000 in our example that's allocated to these items. Now, the formula is done by a cost segregation study firm. Okay, we don't do this. We don't do the surgery. The firm actually has their own formula, their own engineers that give you the report. You have to pay for the report, and the report cost is tax deductible. And in the example I gave for one of my properties from the 5-year and 15-year items, and let's talk about the 15-year items, things like your fencing, your driveway, your walks, other site improvements, they also get a cost allocated to them. And you get 100% of this cost allocated, right? Based upon the One Big Beautiful bill. Okay, 100%, right? And this is important because if it wasn't passed, right, in 2025, it would be subject to the original schedule, which for 2024 was 40%. Now you get 100% of that cost. Now, this is an expense that's taken in the first year in addition to your regular depreciation. What does this do? This creates a huge phantom loss because we don't physically pay depreciation, right? It's not real dollars, okay? We actually get the huge phantom expense, okay? And this creates a huge phantom loss. Okay, along with your mortgage interest, your property taxes, any repairs and maintenance, legal fees, things of that nature. And what this does is it creates an opportunity for you to offset all other income if you utilize a real estate strategy like real estate professional status or short-term rental loophole. So if you want to learn more, go ahead and click the link in my bio, join my free live training or join the mastermind. It is tax deductible. There is a summer special. It is half off. It will revert back to full price in September of this year, 2025. I hope to see you guys in there. We have a group coaching. It is a private community off of all social media platforms under which I actually answer all questions. And we do have yearly meet and greets so that I can meet you. And for those of you who don't know me, I am Natasha Varela, also known as the Money-nista, 20 plus years in audit, accounting, and tax, 13 in the large business and international division of the IRS. I'm a business owner, real estate investor, enrolled agent, and most importantly, a tax strategist.